Vistry Group was the market's focus after a report on Allianz Trade. It could cut supplier credit limits by up to 70% on new agreements. The shares fell about 9%, as investors read that as a cash flow warning. That is not the same as a confirmed supply chain stoppage. The reported change is forward-looking, and Vistry said it knew of no supplier withdrawal or interruption. The central question is therefore narrower. Can a change in supplier confidence force cash out before homes are completed? If it can, the headline becomes an operating constraint rather than a market rumor. The report lands on a company already trying to generate cash and reduce debt. Net debt was close to £800 million at the half year. Vistry had accelerated supplier payments, discounted completed homes, and slowed construction. If insurers reduce cover, a supplier may ask to be paid up front instead of extending normal terms. That mechanism would make each new build consume cash earlier, even if the order book remains intact. This makes the 70% figure a stress test, not a forecast of a 70% cash hit. Its significance depends on how much new supplier trade is affected and whether other insurers replace the cover.
Vistry is not presenting an empty pipeline. It reported a £3.9 billion forward order book and was around 80% forward sold for 2026. It's still guided to more than £100 million of net cash by year-end. Those figures support the company's defense. Demand visibility is not the same as liquidity comfort. A forward order can protect future revenue, but it does not remove the cash needed for materials and upfront supplier bills today. The dispute is now between two readings of the same business. Vistry says cover remains substantial and operations are uninterrupted. The market is asking whether the terms behind that assurance are tightening. The earlier results explain why the market is sensitive. Vistry expected a first-half loss of around £30 million. That compares with an £80.6 million profit in the first half of 2025. Finance Director Tim Lawler is due to leave in October. That history does not prove Allianz's action will damage Vistry. It does explain why a private signal about supplier cover can move the shares before a public cash flow number arrives. The next hard checkpoint is the 24 September half-year results. Until then, the strongest conclusion is conditional. Vistry's order book offers room to recover, but cash conversion and supplier terms must hold together.